investment landscape, the pursuit of better risk adjusted returns is not just a goal, it's a necessity. The evolving dynamics of markets calls for an approach that transcends conventional boundaries, steering towards alternative investment strategies. Our next and last discussion delves into the significant role these alternative strategies play in sculpting a resilient and prosperous financial future. These aren't just investments, they are the keys to unlocking potential in a world brimming with uncertainty. The topic is role of alternative investment strategies for better risk adjusted returns in the future. And the panelists are Mr. Praveen Kumar. Mr. Praveen is the CIO of Alpha Grep Investment Managers. His career began in 2008 at erstwhile Edelweiss, where he significantly contributed to scaling the systematic trading desk over 9 years, transitioning from a researcher to a portfolio manager and then to a team leader. He innovated India's first IPO-based mutual fund during his tenure in asset management at erstwhile Edelweiss. Later, he moved into alternatives, managing a Category 3 AIF before becoming the CIO at Alpha Grep, where he spearheads product design, strategy allocation, and the risk framework. Mr. Vineet Jain. Mr. Vineet Jain is the CEO and founder of Volvin Limited. He has over 30 years of equity market experience and has championed the covered call strategy in India. Volvin Growth Fund has been ranked among the top funds in the long short category and also the mutual funds on Sharpe ratio. Jen, a thought leader and advocate for the covered call strategy, wishes to prove to the conservative investors that higher returns can be achieved with lower risk, and also that derivatives through instruments of speculation can be used for hedging and alpha generation. Mr. Raman Nagpal. Mr. Raman is the founder and managing partner of Alt Acura. With a bachelor and master's in computer science, an MBA, and a CFA. He is also a certified corporate director from INSEAD Business School. Raman spent the better part of 2 decades of his professional career running global high technology businesses. After being associated with organizations like Motorola, Apple, and Microsoft, and successfully founding and managing his own startups, he was subsequently on board of Adobe India and Mopria Global Alliance and ran one of the 3 global businesses Adobe had at the time. Along with his partner, he set up Acura Cap in India in 2009, primarily as a family office to manage their own proprietary capital using cutting-edge algorithms. Mr. Raman manages about $500 million of public and proprietary funds. This session will be moderated by Ms. N. Mahalakshmi. Ms. N. Mahalakshmi, a financial journalist of 25 plus years, is an authoritative media voice. She is part of the senior leadership team at Network 18 and currently leads markets and economy coverage at Money Control. She was earlier the editor of Outlook Business and Outlook Profit magazines, and before that, the editor of Markets and Investing at Business Standard newspaper. Over to you, Ms. Mahalakshmi.
Thank you so much, Akruti. It's an absolute delight to be moderating this panel. And like I said also in the previous session, I'm here to learn as much as to moderate because this is a absolutely untouched topic. I myself don't understand too much of quant strategy and algo, and all of it is making headlines. And obviously, you know, the first thing that comes to your mind when you think of derivatives, also because of this iconic statement that Warren Buffett once made about derivatives being the weapons of mass destruction, and now high decibel stuff coming from the regulator saying that 89% of individual traders lose money. The moment you hear derivatives, there is this, some kind of it's some kind of a terrible thing or something that we should be fearful of. But these gentlemen are telling us that here is derivatives in the form that makes your investment better and adjust for risks, or is capable of delivering better risk adjusted returns. So this is an exciting space indeed. So thank you so much, Raman. I'll start with you. um, Also, because I'm personally greatly inspired by your personal background. You were a tech professional, got into investing, and look what you're doing. One would have at least expected you to invest in Silicon Valley companies. That would have been very thinkable. But getting into, modeling and quant-based investing perplexes me. So take us quickly through your journey, and what is your fund, and what does it do now? And of course, I have to mention that your first fund has been topping the chart for many, many years. I think more than 10 years now.
Yeah. Thanks, Mahalakshmi. By the way, I do invest in Silicon Valley stocks as well on the prop side. But that's for a different day. So I think the introduction covered my background pretty well, so I'm not gonna spend too much time on that. But essentially, a techie, a computer scientist who ended up running high-tech businesses and then developed interest in finance primarily from a very selfish motive of maximizing my own wealth. Developed a few algorithms, experienced pretty good returns, and because our strategies were doing well, a few partners in the industry nudged us into converting this into a fund. That's the genesis of AccuraCap. Um, Done pretty okay. In fact, Kamal and team have awarded that strategy for the last 2 years as the best performing PMS across categories, adjusted for risk. The long short part of it, or the alternative part of it, is fairly recent, where I launched a second venture called Altacura that focuses on returns which are significantly less correlated or uncorrelated to the general market direction. And there was a very specific reason for that, from wealth maximization to sort of more stability seeking strategies that I wanted for part of my wealth. And then, of course, because it did well, we launched a fund which, again, since its beginning, has sort of been probably the best performing absolute return fund in India. That's called the Altacura AI Absolute Return Fund. So yes, it's been a very interesting journey, a very intellectually satisfying journey as well for me.
Fair enough. So quickly, let's go over to Praveen. Praveen, take us through your fund. What exactly does it do? What's your strategy? What is your corpus? What is the offering really like?
Sure, sure. So to start off with, we currently we have two funds. One obviously is a little older. One is we've just started in January. Overall, the philosophy for both largely remains the same, as in it's both a quantitative kind of an investment philosophy. So the earlier fund that we launched, it's going to complete roughly about 2 years now. That's called the Absolute Return Fund. So again, like what Raman mentioned, it's similar kind of a positioning. Basically, the objective is there that we want to provide some kind of a low risk alternative to investors, which obviously, because it's low risk, we are looking at more debt kind of returns, right? But the objective there is to beat like a debt benchmark with liquidity, with much better risk adjusted returns, right? So, for example, just to give you like a random benchmark, like let's say if a liquid fund gives you today 7% at a gross level, right? So, post tax, once now that the tax has changed, that would probably range to about 4 to 5%, depending on the tax bracket that the investor is in, right? So, the objective of an absolute return fund for us and for anyone else in this space is to deliver alpha on top of that 4 to 5%. Right. So in our perspective, what we are looking to target to investors is about 7.5 to 9% post fees and tax. With liquidity, obviously, we are not locking up liquidity in any sense. And obviously, you do have some incremental risk because these are not risk-free or arbitrage strategies per se. So that's the fund that we've started with. Currently, we've capped out that fund at close to 1,000 crores, primarily because what we run obviously are fairly active strategies. It's dependent on the underlying liquidity. So that's the first strategy that we run. It's broadly a mix of three different kinds of quant strategies. And maybe we can go through some of those little later. I don't want to fog all the time here. The second strategy that we've just recently launched, there the objective is to provide an alternative for an equity or like an index investor. There again, the philosophy is similar, as in we just overlay a long short strategy on top of an equity portfolio. We're not doing anything fancy on the equity part. It's a simple passive play. We just run some of our long short strategies on top of the overlay as such. So both of these vehicles are currently live. One of those, like I said, is about 1,000 crores. That's the first one completing about 2 years. The other one we've just started. So it's just completing 2 months, right?
So your second fund is exactly like Raman's fund also, right? Like it's a passive fund, and then you have a.
So I think Raman, so Altacura also has a new fund in that space, right? So Altacura has two funds. Again, correct me if I'm wrong, Raman. So they also have one which is more of an absolute return, and then one which is more of a equity alternative. So again, our
Right.
both our funds are in the same kind of space.
That's correct.
Okay, cool. Vineet, you want to come in on your fund?
Yeah, thank you, Mahalakshmi. So, lot of unique things. I don't know where to start. So, it's the first fund on covered call strategy in India. In US, it's a very, very popular strategy. BlackRock says making more by losing less. So, we have almost 150 to $200 billion investments in covered call funds in the US. That is almost, somewhere close to 1% of the GDP. But in India, this number is abysmally small, near zero. Even if we go to, have a benchmark of having fund size similar to US, this strategy itself would be bigger than the total AIF industry we have right now. So it was an opportunity when we tried as investors to get a fund manager to manage uh, a portfolio on covered call strategy, but we couldn't find any takers. It was hardly unknown in India. And we were advised by some friends who've been in the industry for a long time that, there are no people here and people don't understand it as much. And whoever is doing it on their private books. So, and it's a great strategy with good returns and lower risk. So why don't you start the fund? And so we are investor turned fund managers and managing the fund. I myself have been in equity market for almost 35 years now as a kid. And then, during Harshad Mehta time, made good money and lost all the money. But in my master's in finance and marketing from MDI Gurgaon, what I realized was that returns are very easy to calculate, but what is important to manage the risk. So our fund, or rather the covered call strategy itself, manages risk on its own. The strategy inherently has a lower risk. So in this fund, equity and derivatives are equally important. We cannot say that derivatives is more important or equity is more important. And like you said, people perceive derivatives to be the weapons of mass destruction. And India is almost 30 times more speculative than even the Indian markets. Sorry, Indian investors or speculators are 30 times more
Yeah.
speculative than the American markets. And the more speculation is there, the more people tend to believe that derivatives, like you said, SEBI has also reported something similar. But we are on the opposite side of the risk taking or the derivatives, because we use derivatives not to speculate, but to hedge the portfolio when required, and also to create monthly returns on the portfolio. So Volvin, as our name, Volvin stands, been very, very carefully thought out name. It stands for volatility and winning, wherein both play an equal role. So everybody is scared of volatility, but the fund feeds on volatility. We feed on volatility and we try to take it to our advantage, and also use derivatives to sell call options on the underlying portfolio every minute, every hour, every day the market is open. So a lot of unique things, equally balanced between equity and derivatives, and the kind of returns generated, or the alpha, is fairly good, and with much, much lower risk. I think a sharp ratio of 3.4 is hardly unheard of. That in the short, even though we are very, very young in terms of the fund, but a sharp ratio of 3.4, a standard deviation of less than 8, 7.8%, and extremely probably the most diversified fund in the country with more than 60 stocks in the portfolio. So a lot of unique things, and we focus on wealth creation and not wealth preservation. It's a long-term strategy with low risk and high returns. And I'm sure if you have more questions, there.
Fair enough. So quickly, I just wanted to understand the positioning in terms of return profile. I heard Praveen say that he's targeting 7.5 to 9% post tax, and I have a question on that, Praveen. But before that, what is the return that you target based on the risk that you take?
Okay. So, very simply put it, equity is an investment for long term. And in equities, in the long run, we see 12 to 14, 15, 16% return generation in, large cap or maybe mid cap in the long run. So 12 to maybe 14 on an average if we have a mix of different caps. And as a fund, if I just give you a simple number, if we sell at the money options, the premium is on an average 3.5%, which annualizes to 42%. But for an OTM 5% away, it's about 1.5% premium per month, translating into almost 18%, premium annualized. So if we have a mix of 18% and 42% options, it's about an average of 30% a year. So now you have equity on one side, which gives around 14%, and derivatives on the other side, which gives around 30% a year. So when you marry both the strategies, you will give something that is between 14 to 30 over a long period. We can say an average of 20, 22 is what is suggested by these numbers. And internally, we would be very happy if we delivered the investor something, a pre-tax return of something more than 20%. But of course, there is nothing that is guaranteed. And in the long run, we have seen that in our prop book over the last 8 years, this is exactly what the funds have been doing. The covered call strategies has been doing, delivering around 15 to 30% return on an average. And this is probably the only strategy in equity that will deliver returns even when the market is stagnant. So the month the markets don't do anything, we are the happiest because all the options written, come as profits.
So the time horizon one should have in mind while investing in a fund is what?
So if
When you
somebody,
say 14% is taken for granted, then we all know that equity returns are lumpy. I mean, you don't have like a linear progression for equity returns.
that's right.
While volatility, of course, and your derivative component may be a little more secure.
So if somebody is a first-time investor, then we would say a 3 to 5 year horizon is very good. But if somebody is already investing in mutual funds and has the appetite for equity, then you just have to simply shift to a lower risk strategy because the returns, the Sharpe ratio in this strategy has been higher than all the mutual funds in the country. Ranging from we have PPFAS on one side, which is I would feel one of the most conservative funds, and Quant on the other end of spectrum, which is one of the most aggressive funds. So, beating both the sides. So, somebody who is less averse to risk. So, this is one strategy that is even less riskier than the mutual funds in the long run. So, if somebody is invested, answering your question, in few words. So, if somebody is invested in equity, you can switch from, then you don't need a very long horizon. You can simply switch for even 6 months, 1 year, or up to 2, 3 years investment period. But if somebody is a first-time investor, then we would request him to be have a horizon of 3 to 5 years because that's when your chances of losing money are nearly negligible.
Fair enough. I have a couple of more questions, Vineet. I'll come to that. But before that, Praveen, you said 7.5 to 9%. Now, tell me, in the place that we find ourselves in, where most investors are assuming that we are going to see a peaking of interest rates from here on. Debt would give you pretty much the same in a falling interest rate scenario. So why would I get into equities to a equity product which gives me 7.5% when debt can give me as much?
Correct. So, couple of things there. So, obviously, the number that I am talking 7.5 to 9 is post tax, right? So, debt probably, if you leave out the duration component of it, right now you might get
But
like, let's say,
today's timing is such that you will get that extra in
correct,
debt, right?
correct. So yes, but there is a different kind of a risk you're taking in that kind of a product, right? So you're taking duration risk, and obviously, if it works out, you get rewarded for that. So the other point that I wanted to highlight is, so yes, we do use equity instruments, but the resultant profile of the fund or the product that we are selling, that is pretty much a debt kind of a profile, right? Because there are different ways that you can structure the risk, right? So you can use derivatives, and which is why I think I kind of detest that statement that derivatives are a weapon of mass destruction. Is that if you use it correctly, they are
Yeah.
probably the best tool to hedge risk more than anything else, right? So in our strategy, at least what I can confidently say is the use of derivatives is largely to eliminate or to reduce, not really eliminate, but to mitigate that component of the equity market risk per se, right? So when you buy any stock, there are two risks that you're predominantly taking, right? One is the market risk, and then there is that stock specific risk. So as far as possible, we use equity instruments and derivatives to eliminate that market risk component. And then what you have is typically business risk or that company risk. So what that gives you as a profile is much lower in terms of volatility and in terms of risk or whatever risk measure that you have. And therefore the product, both from a return and risk perspective, more comes closer to a debt product, right? So I'm not really looking. So let's say if the index gives you 12% on average, or let's say the last 5 years or 6 years, that's been the number, the volatility would probably be closer to 15, 16%. In a fund like ours, you're looking at a volatility of 4%, right? So if you were to look at, say, the 10-year bond, the 10-year GSEC in India, again, that would be at a 5 to 6% kind of a volatility, right? So from a volatility perspective, it's also a debt kind of an instrument. Yes, you are using equity instruments, but you basically transform the return profile closer to a debt instrument. So that's why the number.
Fair enough. Raman, if you can just take us through your strategy a little more in detail. I'm curious to understand how do you manage the part, like I understand the passive part. Please tell us about the rest of it that you manage through your quant or whatever you do. Take us through what is that strategy like, and what are the inputs that go into it, and how do you manage that?
Sure. Maybe Mahalakshmi, what might help here is going a little to the foundations of what we do as an industry, because that to some extent will further explain what Praveen does or what Vineet does as well, besides what my team does. Think of derivatives as a class of instruments that has two very unique properties. One, it has a return altering property, which is the direction that the returns take can be completely different than the underlying based on how you position the derivative. So it could have a correlation of a big plus to a big minus to the underlying, right? The underlying in this case, for the benefit of investors who may or may not be very familiar with all the terminology, means let's say a stock or an index.
Right.
Usually, as a traditional long only fund manager, as a mutual fund, for example, or other ways, you would make money by buying an asset and then hope that it appreciates. And if you are worried about it going down, typically the best you are able to do as a traditional fund manager is get out of it and avoid some of the downside, right? But you cannot profit from assets going down in a long only format. That's what derivatives do. They allow you to go beyond just avoiding losses. They allow you to actually go against the tide and therefore make money when something is going down. So that's a fundamental property of derivative that helps. It can be used as a hedge. It can be used as an alpha creator. The second property that derivatives bring, and this is where a lot of risk comes, and that's why terms like weapon of mass destruction come, is its ability to leverage. With 100 rupee, unless you leverage, you are able to buy assets worth 100 rupee. With derivative and with other instruments that allow leverage, you could actually buy stuff worth 200, 300, 400 with 100 rupees. Now, what that does is if your bet goes right, your returns multiply. But
Yeah.
if your bet goes wrong with leverage, obviously the losses can wipe out your capital.
Right.
Now, a combination of the two properties makes for very interesting stuff. With a +1 to -1 in direction, multiplied by 2, 3, 4, you are basically saying your returns could be 2 to 3 times up or down on an underlying very easily if you use derivatives in particular manner. So therefore, derivatives are actually a weapon. It's about in whose hand and how that weapon is being
Right.
wielded. Now, what Praveen's funds do, based on my limited understanding of what he described or what Vineet does in terms of covered calls or what my team does, think of broadly all of these strategies as comprising of two distinct components. Those components can have further subcomponents. Okay. Component one, which is mostly to do with an underlying product. That could be a fixed income product, that could be equity, that could be index, that could be an actively managed portfolio. The returns there will be very similar to like any other normal fund
Mutual.
dealing
Right.
in that asset, right? So if that component one happens to be FD or fixed income, the returns will be very similar to that FD or fixed income kind of returns.
Correct.
Look at the second layer as comprising of hedged
Analysis of
or
the
somewhat hedged or
macroeconomy.
unhedged strategies in derivatives that use the components one value to collateralize, create margin, and create alpha on top. It could be about selling covered calls as Vineet does. It could be about hedge trades. It could be about anything. It could be using algos, without algos, using trading experience, whatever. But the goal is to log the layer one returns, which any normal fund would anyway give, and then use this component two to create alpha on top of it, right? Now, if the underlying layer or the component one is debt, it becomes a debt plus or absolute return type fund, where the stability can actually be even better than debt while the returns are better. Just to give you a sense, we launched our fund 27 months ago. The fund over 27 months has had one drawdown month of minus 0.17, no drawdown month. Even fixed income went down 3 times over this period. Nifty over this period gave a return of about 19%. The fund has grossed 38% over this period. This is gross. Remember, a lot of the derivative income gets taxed at maximum marginal rate, and so therefore realized in-hand returns are significantly lower than the gross. And then there are fees, etc. But that gives you a sense: significantly higher returns, significantly lower volatility. This is where the derivatives had a protective effect, right? Now, if the underlying component instead of being fixed income becomes equity, Nifty, for example, what Praveen was referring to as
Yeah.
passive investment into
Yeah.
stocks, which is, let's say, mimicking Nifty, right? Now, that will give you Nifty like returns anyway. The challenge is most mutual funds in equity these days are struggling to outperform Nifty. Look at large caps. In the last 5 years, top 10 by market or top 10 by AUM funds, only 3 of the 10 have been able to beat Nifty.
Right.
The funny part is the 7 that have not been able to beat Nifty, many of those are the ones which are actually beating Nifty in the prior 5 year period. And
Correct.
investors and advisors, unfortunately, keep chasing those historical outperformances and keep suffering because they are probably entering and exiting at the wrong time because of the cyclicality. Not that these fund managers are bad or funds are bad, just that they need suitable conditions aligned to their strategies to create alpha.
Right.
My prediction is given the increased optimization efficiency of the market, beating index or Nifty in the large cap space, especially, but also in, let's say, multi cap is going to keep getting harder. Also, behavior of investors to chase returns rather than being able to tell what cycles are aligned and therefore entering at the bottom rather than the top of the cycle is going to be hard. And
Right.
so they will probably find it very hard to beat Nifty through traditional long only funds. And
Right.
this is where this layer two that creates alpha on top of the underlying will help. So you have two kinds of funds, therefore, one which is debt plus, which will create alpha on top of debt, and equity plus, which will create alpha on top of equity. The two funds that Praveen runs, the two funds that my team run, do that, debt plus and equity plus. From what I heard Vineet say, His is slightly different, where he's focusing mostly on the covered call, but that's an equity plus type of product. Okay.
Right,
So
right,
those that I think that gives some context to the viewers to sort of really understand how these
right.
things work and how they may be useful.
So now delving further on your, you have an equity component and then you live, so talk about the plus part.
Okay. So the derivative layer on top essentially is very similar. As I said, the underlying layer could be debt, in which case it becomes an absolute return fund, or it could be equity, in which case it becomes an equity fund. The layer two remains the same, and the layer two is not one strategy or focused on sort of a particular way, but it's actually a very diversified set of multiple strategies divided into three buckets, each bucket into further sub strategies, from wall dispersion to making view based option strategies to even covered calls, right? To actually everything is a part of it. The algorithms that I have developed over the years help my team generate short term signals on the likely direction and the extent of movement of an underlying, whether stocks or indices.
Hmm.
And if you can get it right, even 51% of the times, there's a lot of money to be made from well understood strategies, right? If you know a stock or an index is likely to go up, there are different ways to make money based on how bullish you are. Or if it is going down, there are multiple ways to make money based on how bearish you are, right? So the magic is not in using those straddles and strangles and bull and bear spreads. The magic is in how accurately you are able to predict the movement of underlying. And that is where perhaps if most of the fund managers would have some edge, right? We use extensively algorithms and a very diversified set of algorithms. So the idea is, of all the strategies that you're simultaneously using, some would do quite well, some would do probably okay, and some would not do well. As a portfolio, that leads to a very strong consolidation of returns where every month it creates some alpha. And that's why over the 27 months, we've seen the kind of steadiness that we have seen. So that's sort of the general philosophy here, right? Which is lock and underlying, create alpha, and therefore change the profile of the total product from just the underlying with more volatility to better returns with less volatility.
Sure. And the layer two, usually yeah, the trades are with respect to individual stocks, or is it only, index components?
Usually, these trades are hedged, involving both indices, more specifically Nifty and Bank Nifty, sometimes Fin Nifty, as well as components typically of these indices. Sometimes it could be indices against its components, sometimes it could be components against other components, it could be a
Right,
traditional long short, it could be vol dispersion,
right.
multiple strategies, but both indices as well as stocks.
Okay, fair enough. Vineet, you talked about your covered call strategy, right? So I have always wondered, why is it that mutual funds, because they're also allowed to, write calls at least 20% of their portfolio, if I'm not wrong, 15 or 20%, I don't remember the
15%.
limit. But they're allowed to, but hardly any of them use. I think you mentioned Parag Parek. I think Parag Parek uses it, and Prudential uses it, and I don't think more than a couple. Quant also uses it, but none of them really use it. And as per my understanding, most of them say cost is a bit of an issue. And if they were to have a negative call on the stock, the way they look at it, they might as well sell the stock than to do anything with the rest of the, go short and stuff like that. So my question to you is, in terms of costs of managing this component, how does it work out? Is it favorable on a sustained basis? Are you able to cover for those? Because over long periods, costs matter a lot when you manage a fund.
So I would want to add here what Raman mentioned earlier, So more than the cost, uh, mutual funds do not have the option of shorting. So this is where the hedge funds or the alternative funds, have an edge that you can make money on both sides of the market. Even where the market is going down, you can make money, but there is no way a mutual fund can make money when the market is going down. And the expectations set from the mutual fund are not unrealistic. They are very realistic, and they are supposed to, do similar to what their benchmarks are. So if there's one fund which is a nifty fund or a large cap fund, whatever the benchmark is, they're supposed to, mirror similar gains. So if the market goes up, the mutual funds will go up. If the markets go down, the mutual funds will go down. Tomorrow, if the markets go down, nobody is going to blame the mutual fund manager that you've not done well, because his job is to try to outperform the benchmark and not really worry if the market is gone down 20%. So but in case of alternative funds, like Raman added very beautifully, there are two sides. One is the debt side, wherein your risk is lower and you've locked in the debt gains, and there's the equity side where you have a relatively more risk. And on top of it, like it's like the bread and butter. You have the bread, and you're creating butter on the top by using different strategies, which you have more. You need more creativity and more flexibility in terms of uh, I would not say flexibility. I would say you need lot more details, data studying and data analytics and building those strategies using of algos to create that cream is not easy. A long only fund or a mutual fund will simply do the fundamental analysis and try to buy stocks that will probably do better than his benchmark, and try to and hope to beat benchmark, or at least do as the benchmark does. And for this, if you want to do as the benchmark does, you cannot have 100 rupees and not invest 100 rupees at all times. They will have to invest most of the money, 95, 98, 99% of their funds, in the strategy they have, long only stocks they have, in that description of each stock, what is the portfolio size, in terms of how much percentage you're holding in your portfolio that stock. They will have to maintain that. For example, if Nifty goes up, market goes up 20%, and the fund manager was sitting only on 80% stocks and 20% cash, he would have underperformed, by about 4 or 5%, and that would be the death knell for the fund or the fund manager. You cannot underperform the Nifty. So in our case, now coming to your cost thing, uh, as a strategy in our fund to reduce the risk, we also try to do what Warren Buffett says. So Warren Buffett says, be greedy when the markets are fearful and be fearful when the markets are greedy. So he says, think emotionally, think what the market is doing, and do not be a buyer at all times, and especially buy more when the market is falling down. So we have taken a cue from that, and we never, as a fund philosophy in our fund, want to be 100% invested. So our average target is that, okay, we will deploy only 70% funds to, generate alpha. Thereby, if out of 100 we have deployed only 70 rupees, automatically the risk is 30% lower. So on the balance amount, we have to fund the margin, and if you want to sell options, you would need some margin. So, but because we are 70% invested, we have that extra money, and we do not have to incur too much cost. But for a mutual fund, which has to mirror or beat the benchmark, for him to take out 5-10% of the money could be a big hit. If the Nifty has gone up 30%, they may lose 1.5-2% on simply these costs where you have to fund the margin. So for them, yes, cost could be an issue because they want to be invested almost the whole amount at all times. Unlike alternative or hedge funds, wherein you will may not want to be fully invested because you have a negative view and you would want to make money even when the market is going down. So this is a very, very clear edge that hedge funds or alternative funds in India have to participate and create alpha whenever the market is going up or going down. It's your call. At least you have that ability to do it. Mutual funds do not have that ability.
No, I'm specifically asking about cost of managing. I have understood the overall concept and why you're able to reduce risk, but specifically on costs, does the churn and transaction cost tend to be high, and how much is it? I mean, can you give us some flavor of that?
So in our fund, I can talk about our fund because different strategies would have different things. But uh, on the long only side, on the equity side, we are extremely passive. We have 60 stocks, and we do not want to exit the stock in a hurry. Uh, and for our fund, our churn was about 17%. So this is much lower than the average 25 to 40% churn that most mutual funds have Quant has maybe 200%, that is very, very high. But even comparing to conservative equity funds, our churn is much lower. Because if fundamentally we identify a stock, so there is a benefit that we have. A mutual fund would always want a stock to go up. In our case, we even those stocks which do not look too bullish but look very stable are very good for the portfolio because we can have a stable stock and we can still money by writing call options every month. In fact, we would want a more stable stock than a stock that is too volatile going up every other day. That way there's an inherent strength. Sorry, and your question was, can you just
No, I was just asking about costs.
so churn is
Churn
less.
and cost. Yeah.
Yeah, churn is less, but on the derivative side, it is 10 times higher volumes. Because on the whole portfolio, every month we will have it's let's say it's a 60 crore fund. We are very, very small size as of now. But so if the 17% churn is there, it could hardly mean maybe 15, 16 crores of churn on the equity side. But on the derivative side, we will have to sell the call option, buy the
Yeah.
call option back, sell next month call option. So there
Yeah.
would be a 120 crores, almost 10 times the churn on the derivative side. So
Yeah.
yes, in terms of costs, in our particular strategy, we cannot use too many algos. I'm sure on Bank Nifty and Nifty, the algos are very, very accurately used without much cost. But in our case, the markets for stocks, derivatives are still not the call option side, not the futures. The call option side still are not very liquid. So if we use algos, we would hurt the fund by about 3% a year. So we use, teams, but even these teams cost about 1.5% only to sell call options and to cover the call options every year. So cost wise, yes, it is a big cost. I'm not sure if mutual fund, because the strategy itself is different.
Yeah.
Buying equity side, the costs are nothing. But yes,
Yeah.
on the
No, no,
derivative.
overall fund cost, because that's always cited as one of the reasons why funds are not keen on doing this. So that's why I want to understand from your
So it
perspective.
is it is the, I would say, not cost, but an opportunity cost. It's an opportunity if they use some cash and they are unable to deliver, and they miss the benchmark, it can be very lethal for because their ranking would go down sharply and everybody tracks how the fund is faring. So for that, I think opportunity cost is a bigger issue than the cost itself.
If I may very quickly add a little point, Mahalakshmi, that might
Yeah.
actually. Uh, while it's not clear to me what context was in which the cost was referred to, my guess is given the scale and something that Vineet talked about as well, given the scale at which mutual funds work, for any meaningful stock options to be used as hedges, right? Would require fairly substantial stock specific options. Now, the reality in India is that unlike indices, where options are still, unless you're sort of looking at really deep ITMs or OTMs, there are still reasonably, liquid options. With stocks, the liquidity dries up very quickly as you go from
Yeah.
large to small stocks.
Correct. Correct.
Mutual funds dealing with hundreds or thousands of crores, the cost may be less about the transaction cost because brokerages are minuscule in derivative, and for mutual funds, it should be fairly easy for them to negotiate good price. It's probably the impact cost that they're worried about, other than the opportunity cost of laying some money out for derivatives and therefore missing out on the run up if that happens because
Yeah,
they're clearly
that's
anomaly.
that's
Correct.
totally
You're right on the impact. Yes.
the impact cost because
Impact cost is definitely,
on
yes.
a 40,000 crore fund, even if you allowed 15,000 crores, 15%, that could be about 6,000 crores. And if you have 20 stocks, 300 crore options in a particular stock would
Yeah.
simply kill the premium from 3% to maybe 1.5%. And then it may not be viable for them because, if an operator sees such a low, premium, he would rather move the stock and, the mutual funds may lose a lot of money. So
Correct. Correct.
Aman is right. The impact costs for stocks are very, very high.
True. True. True.
And when the market goes
That's
bad, there is the prices, option prices in stocks that disappear. And too much volatility, so nobody wants to sell a call option, so nothing is available. You cannot square off a trade. It's only in the indices, the Nifty and the Bank Nifty, all the options and all the volumes are available because the market has to be there. But a stock, the volumes, I have seen many times the volumes in options, they will simply dry up.
Hmm.
So that problem is what Raman has identified
Yeah,
before.
the impact cost problem is absolutely real. That's true. Praveen, I wanted to get some sense on, on your strategies. Actually, all of you. I mean, what kind of, back testing has gone into your strategies and are there certain market conditions under which, certain return predictions can be made? Does it work, not work, under different circumstances?
So I'll answer both the parts separately. So on the backtesting, yes, obviously, like any other systematic slash quant strategy, we also do like a fairly rigorous backtest. So it depends really on the nature of the strategy, how active it is. So let's say, for example, if I have a strategy which on average holds positions only for a couple of days, for a strategy like that, you might be okay with, let's say, 2 to 3 years worth of like historical performance, right? Whereas if I have a strategy which holds positions, basically how many times it turns over, let's say it holds its positions on average for about a month or two, there I'm obviously looking for a lot more number of instances, right? So there you would probably look at like a few years at least. So 10 years worth of data or something like that. So the strategy backtest, the duration of that really depends on my holding period and what I'm trying to achieve, right? So, and generally, what you'll see again, this is not really a truism, but what you'll see is the shorter that your holding period is, obviously, pretty much by definition, the risk kind of goes down, right? Because how much can the underlying move in that short kind of a period, right? So that's how it's kind of correlated. And for any kind of a strategy, that is what you're trying to look at. So yes, you will look at a backtest, but eventually, I think anyone who's been in the quant systematic world will tell you that obviously, I mean, you have to take those backtests with a fair amount of salt, right? Not just a pinch of salt, right? So typically, what happens is, and this is where the human element kind of comes into play, is how much do you kind of adjust for what you're seeing? Because eventually, I mean, you can massage the data as much as you want. It's pretty much going to tell you what you want to say, right? And that is where the judgment element or the human element comes in. How much do you actually believe that this is sustainable in the future? And that is where I think you need to look at beyond the backtest. And therefore, what you do on a live track record is really a marker. Your backtest could be indicative. I'm not saying totally discounted, but it's only tells you the direction of whether the strategy might or might not work, right? So overall, you need to let it run for some time, and that's when you kind of evaluate the strategy. And I'm sorry, your second part of the question was?
Um, I think that's all I asked.
Okay. Okay.
Okay. Um, so yeah, that's just one thing that I wanted everyone to talk about is, how scalable do you think? I mean, each one of you, Raman, maybe you can go first on how scalable is your strategy? How much can you run? How much runway does your fund have to be able to effectively deliver on the return targets that you have in mind?
Sure. So, if you look at the two funds that I have, one of which is about 27 months old, the absolute return fund, we have a corpus of a little over 1,000 crores. And we actually stopped accepting money 2, 3 months ago, not because there was any capacity constraint with the strategy, but because we still need a well trained team to interpret signals and act on them. And so, therefore, every couple of 100 crores that we add to the corpus requires addition of additional resources. So, while everything else is algorithmic, the final decision making is still left to the wisdom of well trained traders to make those decisions for us. And therefore, our limitation has been people rather than capacity constraint. Now that we've again taken time to scale up the team, we are able to start accepting fresh money in the absolute return fund. The equity plus called Maximus is the fund that we have just launched. And the underlying there is nifty stocks. As you can imagine, there is no constraint of liquidity there. So the constraint, if any, would come from the derivative layer on top as to how much we can create alpha on top of a largish corpus.
Right.
Our experience of running about 1,000 crore corpus with the first fund suggests that we easily have a headroom of probably at least another 1,000 before we would even consider thinking stopping, right?
Sure. Sure.
So for us, at least, we are talking of a few thousands of crores in terms of capacity. But I'll also point out that the markets and the liquidity can be quite treacherous.
Hmm.
What seems like a very liquid market, especially in the derivative segment, can
Yeah.
change overnight basis regulatory action, basis sentiments, basis global events. And I'm sure Vineet and Praveen can speak to that. And so, therefore, we are always careful not to operate at the peak of our perceived capacity ceiling. We try to keep enough headroom so that if it shrinks, we still have time. And we will
Right.
always keep doing that, which is kick the can a little further down the road, expand it again a little, but always keep a healthy margin so that if it shrinks, we still have space to breathe and operate.
Fair enough. Fair enough. Vineet, how about you? How much do you think? Um,
So, Mahalakshmi, I feel for, like Raman also pointed out, this volumes, even in options in 20 stocks of Nifty 50 is fairly good. But in other like there are 183 stocks in the F&O universe. So there can be three areas where some A B C categories where A, the volumes are very very good, B, the volumes are decent, and C, there are hardly any volumes. So we can operate in only A and B. A, there is hardly any dearth. You can possibly have a fund that can go 1,000 crores also very easily. But you have a mix of A and B. Then I think up to 1,000 crore would be a limitation where beyond which we would be impacting the options more, than we would be benefiting from them. So somewhere between 500 and 1,000 crores should be easy. Beyond that would become difficult.
okay. Okay. Praveen?
Yeah, pretty much the same answer. So,
Yeah.
we've also kind of stopped taking money in the absolute return fund at 1,000 crores. One of the main reasons that we run like three classes of strategies, and one of those runs on, say, stocks or stock futures. And that is the limiting component, like, because what you've seen as volume growth in India has pretty much only been on the index option side, right? So our other strategies that trade indices are fairly scalable. But then we can't accept more money because my risk return profile changes if I can't scale up one component. So on that strategy, we've currently stopped taking money unless the liquidity profile for stock futures improves in India. We're not planning to do anymore. On the equity alternative, again, similar thoughts like Raman's, like there, it's a fairly scalable strategy. We would obviously want to stop at around 1,000 and evaluate till some time. But I think beyond that, that strategy should be scalable to about 1,500 to 2,000.
So
Sure.
I want to add one thing here, if you allow.
Yeah.
Yeah, so in US also, most of the funds that are I mentioned, it's almost 150, $200 billion industry there, covered call. So 90% of these funds, or maybe more, are writing the options, covered call options on the index, not on the stocks. There's
Hmm.
only one fund I know in the US by the name of Nanban, something, run by Mr. Gopalakrishna. He's also an Indian who runs the fund, and it's a $2 billion fund doing it on stocks like us. So the size in US is $2 billion, but I think most of the other funds like $18 billion, $12 billion, all the big funds, they are doing it on the index only. Yeah. So index, if somebody, the volumes are very, very huge, but on stocks, I think the market still has to, gradually move up and have more volumes.
Fair enough. That's all we have time for. Thank you so much, gentlemen. I personally got to learn a lot from this discussion. And Raman, thank you so much for breaking down this whole strategy and product very clearly for all of us. Thank you, Vineet. Thank you, Praveen. Had a great discussion. Thanks so much. Thanks so much, Kamal, PMS AIF, and over to you, Akriti.